All of this information will apply to you. You can download the slides by using your camera app on the QR code, which we will show periodically during this broadcast. If you have questions, please note them in the chat at any time. We will answer all the questions at the end. As we are going through these topics, if there is a particular segment, topic, or situation you would like to see a future seminar about, please leave it in the chat or message the organizers at academy@bedfordpresbyterian.org. My name is Jennifer Climo, and I have been providing income tax advice to individuals and small businesses for over 30 years and financial planning advice to individuals and couples for over 18 years. I'm a certified public accountant, CPA, and a certified financial planner, CFP. The views expressed today are mine alone and are not the views of either Bedford Presbyterian Church or Milestone Financial Planning. Nothing you hear today should be considered investment advice. Note that almost all financial decisions will impact your income taxes or estate taxes now or in the future, and the tax consequences should be evaluated before you take action. Do not make financial decisions based on this or any other seminar, but instead meet with a qualified financial advisor regarding your specific goals and circumstances, and past performance of investments does not predict future results. TRIAGE is the acronym we came up for this series of classes. Today's topic is the I in TRIAGE, investments. At the end of today's class, I hope you will understand the types of different investments, how the earnings impact your taxes and your wealth building, how asset allocation, diversification, and rebalancing can help you achieve your goals, and what Bitcoin is and why is it getting so much attention. Parable of the talents. In Matthew 14:30, Jesus tells a parable about bags of gold referred to as talents. I mentioned this in our overview session as well. To summarize, a master, God, gave his 3 servants, people on earth, different amounts of gold, money, to invest. The ones who invested were rewarded, and the one that responded in fear and buried the gold was punished. One of the lessons from this parable may be that fear does not make good investment policy. Importance of professional advice. Everyone has different goals and is in a different place financially. Be careful taking financial advice from friends and neighbors. They may have different values, goals, and resources than you, and what is right for them may not be right for you. Investments are the engine that powers your financial plan. Let's talk about types of investments. When you invest, you are either buying part of a company, buying their stock, or lending money to a company or to the government, buying their debt, otherwise known as bonds. There are 2 ways for companies to raise capital for reinvestment in their business. One is by borrowing money. This is known as issuing debt or bonds. For example, they will promise to pay bondholders 5% interest for 10 years. If the company goes bankrupt, bondholders are paid in line with the other creditors. The bonds pay interest quarterly or annually and are taxed at ordinary income tax rates. Once the bonds are issued, they can be traded in between individuals at discounts or premiums to the value. For example, if the bond pays 5% interest and interest rates fall to 2%, then I will pay more in the face value for that bond to get the higher interest rate. The price of the bond has risen. Conversely, if interest rates rise to 10%, why would I buy an existing bond paying 5%? It would have to be offered at a discount to make it worth my while. The price of the bond falls. Therefore, as interest rates rise, bond prices fall, and vice versa. This is an important concept. Now, there are other reasons to own bonds, stability, for example. During stock market crises, investors are sometimes irrational and will pile into bonds regardless of the interest rate, driving the price up. Therefore, bonds can provide some stability to a portfolio. Another method of raising money is by issuing stock. If a company goes bankrupt, stockholders get 0. You can buy the stock directly from the company at an initial public offering, IPO, and then trade it between others, driving its price higher or lower. You can also buy and sell shares on market exchanges once the stock has been issued. The price of a stock is based on the expected future cash flows of the company from both expected dividends and the eventual sale of the shares. Stock prices are also affected by the demand for the stock. When you sell the stock, you're taxed on the profits at a lower tax rate known as capital gains tax rates. Stocks and bonds trade on exchanges during bankers' hours generally 9:30 to 4, Monday through Friday, except holidays. There are two ways for governments to raise money. They have different two ways of raising money because they can't issue stock. They can issue bonds similar to how companies do, and they can tax their constituents. Government bonds are sometimes seen as being safer than corporate bonds because a company can go bankrupt, and governments are generally more stable. However, some governments can also go bankrupt, like Russia, Argentina, Venezuela, and others. The US is considered one of the most safest bonds in the world. Taxes is the other way governments can raise money. Taxes impact behavior, and there is much debate about the consequences of raising and lowering taxes. Arthur Laffer, a famous economist, created the Laffer curve to demonstrate this. The Laffer curve is an economic theory that shows the relationship between tax rates and the amount of tax revenue collected by governments. The Laffer curve shows that there is a certain point between 0% tax and 100% tax where tax revenues are maximized. The curve suggests that starting from 0, an increase in tax rates will increase the government's tax revenue. After a certain point, however, continuing to increase tax rates will cause a decrease in tax revenue. This decrease in tax revenue can be explained by decreased incentives for work, investment, production, etc. The big question is always, where is the ideal tax rate along this curve? What is the optimal tax rate to maximize tax revenue? People have been arguing about this for years and will probably continue to do so. Whenever you hear about politicians wanting to decrease taxes, it is often in reference to this concept. Types of investments. We discussed stocks and bonds, corporate or government, above. Other types of investments include mutual funds. A mutual fund owns many different stocks or bonds, or both. They are priced once at the end of the day, so transactions can only happen daily. Mutual funds are a managed portfolio of underlying investments. Mutual funds all have expense ratios paid to the company that manages them. They distribute capital gains and income to you, the owners. Additional purchases go to the fund company to invest. There are plenty of mutual funds with low expense ratios that are affordable and diversified, but you do need to do your research. Exchange-traded funds can own the same investments as mutual funds and trade like a stock all throughout the day. You can buy it or short it. The majority of trading activity on ETFs takes place on exchanges, but sometimes the management of the ETF has to issue or recall more shares to adjust to the rising or declining market demand. And this may result in a delay, causing a time where the trading value of the ETF is larger or smaller than the value of the underlying investments. That is known as a discount or premium. Annual fees are typically less than in mutual funds. There's also a transparency difference between ETFs and mutual funds. You can look at an ETF anytime and know what it is invested in. Mutual funds report their holdings twice per year. However, I don't believe most investors look at this information regardless if it's available. By trading once daily, mutual funds avoid discounts and premiums and other issues that led to the flash crash of 2010, when electronic trading temporarily crashed stock and ETF prices, triggering all kinds of pre-programmed orders to execute. The market prices recovered a few minutes later, but it was too late for those who had programmed in automatic sells at certain price points. Mutual funds were unaffected since their trades are settled once per day after the markets close. What is shorting? You may have heard of shorting a stock. Shorting is selling a stock that you don't own. You would do this if you expect the price to fall in the future. You have a certain amount of time to buy the stock and close out the position. If the stock rises instead of falls, then you have been squeezed as you are forced to buy at a higher price than at which you sold. ETFs, since they trade like a stock, can be shorted. Mutual funds cannot. Annuities. An annuity is a promise to pay you a stream of income for a certain time period. There are two stages of an annuity, the accumulation stage and the annuitization stage. During the accumulation stage, you have an account balance that grows based on the underlying investments. In the annuitization stage, you have given that account balance to the insurance company in exchange for monthly payments for some time period off in your life. We discussed annuities in detail last week. This week, we're going to focus on the investment account balance of an annuity. When you purchase the annuity, it is shown as an account balance, but this is a little misleading because you can't spend it. There are usually penalties for withdrawals greater than 10% of your account balance, and withdrawals will decrease your future promised payments. I call these accounts as reported fake accounts because the insurance company likes to show them growing by large amounts. But the only thing that is growing is the amount they are using to calculate your monthly payment. You usually don't have unlimited access to the account as you would an investment account or IRA. There are usually two numbers on the account statement: the cash value, which is the balance you can actually withdraw from, and the fake account used to calculate your future monthly payments. They are usually different. If you own an annuity and have not yet annuitized it, get your latest statement and look at the account's balance versus the cash value to see the difference. If there isn't a difference, that may be because the surrender period has expired. Once you want to start receiving payments from the annuity, you give your account balance to the insurance company in exchange for a stream of payments for a certain time period, usually your lifetime. If you pay extra for a life insurance option, your beneficiary can also receive payments for a lump sum after your death. If you don't buy that feature, then after the term ends, death if you purchased it for your life, the payments stop and your heirs don't receive anything. This payment phase is known as annuitization. As we discussed last week, annuities can either be fixed, paying a fixed interest rate, or variable, tied to underlying investments. A fixed annuity account balance grows by a fixed amount and will give you a flat monthly payment when you annuitize it. The payment amount does not change. Variable annuities are usually invested in stocks and bonds, so the annual growth of the account balance is variable. They often have caps on the downside and on the upside of growth and come with additional fees. Indexed annuities are a type of variable annuity where the upside potential is a complicated formula tied to the stock market, usually the S&P 500. It is tied just to the price swings in the S&P 500, not including dividends. Dividends are a large portion of investment returns, and you can be giving up a lot of return by buying one of these. They are rarely the best option for an individual. In 2020, the SEC issued an investor alert regarding index annuities. As with all contracts, read your contract and make sure you understand it before buying. And if you want to own stocks, buy a mutual fund or ETF and skip the annuity with its extra fees. If you own an annuity, when you annuitize it, your payments are typically set for the term. They don't rise or fall. This means that every year your income will buy less as the cost of living will still increase. A variable annuity can have fixed payments or variable payments that fluctuate both up and down with the value of the underlying investments. The major benefit of an annuity is that it grows tax-deferred like an IRA. However, once you buy an annuity, it is difficult and often expensive to get your money back out without annuitizing it. If you have annuitized it, you cannot take out more than the monthly payments, and you've essentially lost access to your principal. If you don't plan on annuitizing your annuity, why have you been paying all those extra fees every year? Variable annuities typically have higher fees than just owning the investments outright. They are most appropriate for people in the highest tax brackets who already max out their 401k and Roth IRA for both spouses every year, but also need tax-deferred growth. Annuity contracts in general have 7 to 15-year penalties charged by the insurance companies for getting out of them if you decide you don't like the investment. I'm not really a fan of investments that lock you up for that period of time. Any income removed is also taxed at ordinary income tax rates, which is another reason they can be inferior to just owning the stocks outright, unless you're in the highest of tax brackets. In general, if you aren't contributing the maximum allowed to your 401k, 403b, or TSP, then you shouldn't be investing in a variable annuity. Even if you want the tax deferral benefits, you need to decide if that compensates for all the extra fees and limitations. Fixed annuities can have a role in a portfolio if there are enough other assets to compensate for the lack of inflation protection. There are other kinds of financial investments, but these are the most common traditional ones. If you have any questions on any others, we can discuss those during Q&A. Inflation. we talk a lot about inflation. Think of inflation as your money buying fewer goods and services, or think of it as rising prices over time. Asset allocation. The most important investment decision you can make after your rate of savings is how much to invest in stocks versus bonds. Way back in 2001, when I was getting my master's in financial planning from Bentley University, my financial planning professor, himself an owner of a local registered investment advisor, taught us that we should educate our clients to put as much into stocks as they can tolerate. Stock returns adjusted for inflation are, on average, 2 to 3 times those of bonds over the long run. What is your time horizon? If you need to spend the cash in the next 2 years, leave it in cash. What is your risk tolerance? If you can't sleep at night without $50,000 in your savings account, then keep $50,000 in your savings account. Just understand that you are giving up the inflation protection. What are your goals? Your goals and your resources dictate your required asset allocation, which may or may not match your risk tolerance. If you have very little saved for a goal, you may have little option other than an aggressive portfolio to reach it. The more you have allocated to stocks, the historically better your long-term returns. But past performance does not predict future results. A cash balance of some kind is usually recommended to pay for emergencies that arise when stock markets are depressed, and also to provide dry powder to invest when markets are depressed. This slide demonstrates the difference in accumulation over 30 years for different rates of return, from 5% to 9% per year. Note that actual rates of return don't work like this. They fluctuate all over the place and may or may not average these amounts. This is for illustration purposes only and is not investment advice. I just wanted to show you that there is a large difference in wealth building between a lower rate of return and a higher rate of return, and even a 1% difference can be meaningful. This is how the prior slide might work in real life. This slide shows the historical 10-year return of a basic portfolio allocated between 3 Vanguard mutual funds, index mutual funds. This is not a suggested allocation or even one that I use. It is a good example because these funds approximate the result of stock and bond indices. These returns are limited to 10 years, not 30, because of the data limitations in the Morningstar software we pulled them from. We could only get 10 years of data. That doesn't really count as long-term, but it's good for discussion purposes. You will see that the 50-50 portfolio earned 8.6%, which seems pretty good. However, the question is always relative to what? When you compare investment returns, make sure you are using the same time period and also factoring in inflation and comparing to other alternatives. As the amount allocated to stocks increases, so does the return. Also, bond prices rise as interest rates fall, as we learned earlier. So with bonds especially, you have to be very careful using historical returns to predict the future. In the past, interest rates fell, and bond prices therefore rose. Will that continue? How much farther can they fall? Remember, if interest rates rise, bond prices fall. Remember, this is not investment advice, and past performance does not predict future results. However, I wanted to show you an example of what investment advisors know. Historically, the more you put in stocks, the more wealth you build. What about risk? Standard deviation is a statistical measure of risk. You don't need to understand how it works to know that a 50-50 portfolio has a much lower standard deviation than a 90-10 portfolio. The standard deviation calculates how much the portfolio will move around relative to that expected return. These movements are not necessarily bad. Remember that a portfolio with a very high standard deviation can move up as well as down. The standard deviation does not predict only downward movements, but upward as well. Volatility is a good thing. Without volatility, you would not see these large run-ups in the market. Diversification and rebalancing. The more you diversify with investments that have positive trending returns, the better your portfolio will return with less risk, less volatility. This is because they have different correlations. Some investments zig, while others zag. Back in 2000, many advisors across the country were losing clients in droves because of the dot-com mania. Advisors continued to tout the benefits of a diversified portfolio, but clients had severe FOMO, fear of missing out, and wanted all their money in internet stocks because their neighbor was making a killing. Advisors were fired. Those clients that remained saw their portfolios increase in the succeeding months due to the diversification, as those in the dot-com-only portfolios tumbled by 50% or more. However, there has also been diversification. For example, during the financial crisis, everything fell together. Similar during the Corona crash. However, the recovery was not at the same pace. Different asset classes recovered at different rates, again proving the importance of diversification. If you are practicing good rebalancing, looking often, trading infrequently, and using relativity bands instead of trading bands based on the calendar, we'll talk about that in a moment, then you may be further helping your returns. Example of different asset classes include United States stocks versus foreign stocks versus emerging market stocks, large company stocks versus small company stocks, growth stocks versus value stocks, both with United States stocks and international, bonds, corporate bonds versus government bonds, REITs, which are real estate investment trusts. They're a unique asset class, and other investments. Correlation. I talked a minute ago about correlation. Correlation is how an asset price moves in relation to another. For example, if you have two investments and one rises 10% but another falls 5%, a 50-50 allocation will look like this. Half of the 10% is 5%. Half of the negative 5% is negative 2.5%. You add them together and you have a positive 2.5% return. You've reduced your overall risk. Correlations among asset classes are not consistent over time, however. But different correlations reduce your risk, and this is why you always want some allocation to non-risky assets such as bonds and cash, as well as risk assets such as small cap stocks or digital assets. Rebalancing. As asset prices move at different speeds, some asset classes will move beyond their target bands. For example, if you have a simple 4-asset portfolio, over time the stocks will overwhelm the portfolio as stock returns are higher than bonds over the long term. Rebalancing sells the stocks when they reach a certain level, say 20% or more than target. So if U.S. large cap stocks exceed 30% of your portfolio, you would sell them back to the 25% allocation, and you would buy whatever's doing the worst, usually bonds, but not always. And usually bonds are doing the worst because stocks in general, the returns are higher than bonds, so the stocks will outpace your bonds in your portfolio. So in general, when we're doing rebalancing, we're selling back to stocks and buying bonds, except when there's turbulence in the markets, and then we could be selling anything that whatever is high and buying another asset class, sometimes different stock asset classes as if they are falling. What is investment noise? Daily movements in the markets. How do you separate the important from the noise? Ignore the noise and stay the course. Follow your financial plan. Talk to your financial advisor. Most importantly, don't make trading decisions based on day-to-day news. What are junk bonds, and should I own them? Junk bonds are corporate bonds issued by companies with a poor credit rating. Since they are risky, they tend to offer a higher rate of return. It is known as yield chasing to try to get a higher rate of return on your bonds. Remember, bonds are in your portfolio for their diversification benefits, not their rate of return. You want them to be steady Eddie, not exciting. Bonds should be boring. Don't take the risk with your bonds, take the risk with your stocks. Let your bonds be the stability in your portfolio. Junk bonds are often very volatile, like stocks. In the 2009 crisis, there were several bond funds that fell 20 to 30%. Not my idea of safety in bonds. Take the risk with your stocks. Diversification takes the guesswork out of investing. You can't predict the asset class that will do best ahead of time consistently. No one has ever done so, so don't think you or your advisor can. This slide shows the rate of return for each asset class over the past 15 years. I can't see any of those numbers, but you can tell that the colors are all mixed up, and it's the same asset class is the same color all the way through. So it's a random selection of what asset class does the best. It is impossible to predict in looking forward. Remember, these are annual returns and don't reflect the intra-month or intraday returns that occurred. If many of you remember 2009, in March of that year, diversified portfolios were down 35 to 40% from their 2007 highs. You wouldn't know that looking at the annual returns for 2009, which show stock returns of 29% to 79% depending on the asset class. That's because by the end of the year, everything had gone up significantly. Own it all. This slide shows you the concentration of worldwide stock market value. When you hear on the news that Greece is having problems, look and see what percentage Greece represents of the markets. I don't even think you can find them on here. It's infinitesimal. Ditto for China. China is 5% of the world market cap. The vast majority of worldwide stock market value is in the United States. Tax diversification is the split between account balances where the distributions are taxable as ordinary income versus capital gains versus tax-free. IRAs and 401ks, the income component of annuity payments and pensions, all of that is taxed at ordinary income tax rates. Your taxable account is taxed at just the capital gains and interest is taxed. Some of it is not taxed at all because it's a return of principal. Those rates are lower than ordinary income tax rates. Roth IRAs and 401ks distributions are tax-free. Risk tolerance. There is a correlation between risk and reward. The greater the risk, the greater the potential reward. What kind of risks are there? There is a risk of loss of principal. This is very different than temporary swings in the stock market. There is inflation risk, which is the risk that returns don't cover the rising cost of living. There is interest rate risk. You choose a 10-year bond paying 2%. In 2 years, interest rates are 4%, and your bond is worth less because who wants 2% when they can get a new bond paying 4%? The real risk you should be concerned about is purchasing power, not loss of principal. If you use mutual funds, for example, that own thousands of stocks, then individual stock loss of principal risk is near zero unless you sell. Don't confuse a temporary drop in the markets with a loss of principal caused by you selling during that drop. We try to buy only high-quality, shorter-term, known as shorter duration, bonds, so they provide stability and diversification benefits to the portfolios that we manage. What are your investment alternatives? Cash, earning close to zero interest, under your mattress. Bonds, also earning very low amounts of income. Stocks, earning more over the long term, but very volatile in the short term. Bitcoin, even more volatile, but even higher rates of return. Example, I'm retiring with $500,000 in a brokerage account. I'm nervous about portfolio movements, so I choose to leave the $500,000 in cash and CDs in the bank. I'm earning 1.5% interest. That's great. Turns out inflation was 5% for the year. The purchasing power of my money has shrunk 3.5% in 1 year. Unless you have enough money saved that your distributions from it in retirement will be minimal, you will need to accept the risk of investing in the stock market or the risk of running out of money before you die. How I manage portfolios is by starting with the family's goals and determining the overall asset allocation between stocks and bonds. Then I further break down the asset allocation into types of stock by location, U.S., international, emerging markets, company size, large companies versus small, characteristics, growth versus value. Bonds are kept high quality, as I want to take the majority of risk with my stocks, not my bonds. The bonds are there for stability, therefore they aren't going to earn much because the more stable an investment, the lower the return in general. Remember, steady Eddie. You want the bonds steady Eddie. You may need to invest more aggressively to meet your goals. Stated another way, the amount of risk you need to accept is dependent upon how much you need to spend when you stop working. I crossed out long-term bonds because bond prices will rise and fall the most based on interest rates the longer the term. It just isn't worth the risk to own a long-term bond, in my opinion. Junk bonds are crossed out because I don't want to take the risk with my bonds. Take the risk with stocks. The upside potential is much greater and the overall risk is lower. Gold is crossed out because the long-term return just isn't high enough for this to be a valid diversifier, in my opinion. Also, the capital gain on gold is taxed at a higher rate, 28%, as it is considered a collectible. But what if I want to put all my money in the bank and I'm never going to stop working, so it doesn't matter? Sadly, many people are forced to stop working in their 60s or 70s due to health problems. Saying you will never stop working is not a realistic way to achieve your goals. Humans are not wired for disciplined investing. We follow our emotions and often make the wrong decision that looked like a good decision at the time. We are wired to make mental errors when it comes to investing. The market tanked and I should have seen it coming. Or worse, you should have seen it coming. I work in this industry or for this company and I know the price is going to go up, etc. I can't tell you how many times I've heard that from clients from whatever company they work for. This kind of emotional thinking does not lead to successful investment outcomes. Just ask employees of Enron or Lehman Brothers. They also thought their companies were doing great. Don't make investment decisions based on your emotions. Using emotions to invest is one of the most dangerous things you can do. For example, the best times to buy have been during the depths of the financial crisis and the beginning of the corona crash, but most people were busy panicking during those times. The idea behind investing is to buy low and sell high. Yet following an emotional investment cycle sparked by reactive decisions may bring the opposite effect, buying at higher prices and selling at lower prices. It is also extremely difficult to accurately time the market on a consistent basis. Investors are better served in sticking with their agreed-upon investment plan. The 2008-2009 global financial crisis offers an example of how an emotional cycle can affect an investor's decision. After experiencing fear during the 2008 downturn, some investors fled the market in early 2009, just before the rebound began. They locked in their losses and then experienced the stress of watching the markets climb. Alternatively, other investors were selling bonds whose prices had risen and buying stocks whose prices were on sale. Staying disciplined through rising and falling markets can pose a challenge, but it increases the chances for long-term success. Missing only a few days of return can drastically impact overall performance. Over a 30-year period, missing just the 1st, 5th, 15th, and 25th best single days of investment performance dramatically decreased investment returns. This is why most investors dramatically underperform the investments that they own. They miss some of the days by selling out at inopportune times. You cannot time the market successfully, so just don't try. A word of caution. Every time there is an election, I have clients who are nervous about the results and talk to us about changing their asset allocation. The political party of president is not correlated with asset performance. This time is different are the most 4 dangerous words in investing. This time is not different. Markets have rewarded discipline over time. This chart shows the growth of a dollar since 1970 invested in an index called the MSCI World Index, not just the United States. You'll see a dollar grew to $80 or so on this chart. If this chart had been just the United States, it would be much higher. The S&P 500 annual return since 1970 is about 10.7% per year on average, which has resulted in growth of a dollar to about $178 during that same time period. News and financial commentary can influence people's views of investing. Without a strong investment philosophy to guide them, people also may follow the advice of friends, neighbors, or family, especially if the insight promises a fast, easy return. Growing wealth has no shortcuts. Success requires a solid investment approach, a long-term perspective, and discipline to stay the course. So what will the markets do? Soar to new heights, crash to new lows. Bitcoin is here for the future. Bitcoin is garbage. Let's discuss Bitcoin. This is not investment advice. nor am I advising anyone to purchase any digital asset, including Bitcoin or stablecoins. This is educational only. This asset class has only existed for about 10 years, and stablecoins have only been around for a couple of years. That said, I find the evolution of Bitcoin fascinating. Friedrich Hayek, famous economist, born in 1899, said this in a 1984 interview. I don't believe we shall ever have a good money again before we take the thing out of the hands of government. That is, we can't take it violently out of the hands of government. All we can do is by some sly, roundabout way introduce something that they can't stop. Resources, if you are interested in this topic, there's a bunch of podcasts I've listed out. What is Money by Robert Breedlove, The Investors Podcast, We Study Billionaires, Unchained, and The Contrarian. There are many, many hours of resources here for those who want to learn more. We are really going to stay at a basic level here, but it's really kind of complicated. It's also super risky. I cannot emphasize that enough. We're going to go through all the different risks, and there's a lot of normal ones, and then there's some unusual ones. What is money? Money is a medium of exchange, a store of value, and a unit of account. Bitcoin is currently a store of value, as with a stock portfolio. It is now a medium of exchange, with more and more countries and businesses accepting it, and it is knocking on the door of being a unit of account. In my opinion, we aren't there yet. When a Bitcoin is created, it is known as being mined. Bitcoins are not actual physical coins. They are digital accounts, pie in the sky, but they're referred to as a coin because that's the unit of account. We aren't going to get into the details, complex details about how Bitcoin is mined, other than to say they're created by computer programs using complex math algorithms to solve equations. Anyone can run one of these computers and download the Bitcoin software for free, and thousands of users do this, creating many nodes, maybe tens of thousands, I'm not sure. Each node verifies every transaction using math. Digital assets, including Bitcoin, are held in digital wallets. Your public wallet address is tied to your public key. Your password is known as a private key. Think of your public key as your email address and your private key as your password. And you need both to access any assets in your wallet. Notably, like cash, anyone with access to both your public and your private keys has access to your Bitcoin or your wallet, whatever else is in your wallet. You can buy any quantity of Bitcoin. You don't have to buy a full coin. You can buy 0.01 or 0.035, decimals go out 6 places, by opening an online wallet at a number of different exchanges. Don't do this until you understand most of what we are discussing today. Bitcoin and other digital assets, again, are not physical things. They are computer-generated information. There will only ever be 21 million Bitcoin. Each Bitcoin is divisible into 100 million Satoshis, named after the creator of Bitcoin, sats for short, which means that one sat is worth less than a penny currently. The current price is approximately $50,000. It changes rapidly all the time, so this may or may not be that at the time you're listening to this. So $50,000 is 1 Bitcoin is 2,000 sats. 1 penny is 20 sats because it can be divisible into 100 million parts. It trades 24/7 every single day. As you may recall, stock exchanges and banks have limited hours. Bitcoin is decentralized, and no person, group, or government can control it. It was created by computer code with built-in protections and limitations. There is no way to bribe a gatekeeper because there is no gatekeeper. Bitcoin has no counterparty risk. The base Bitcoin technology is known as Layer 1. Additional layers of technology can be and have been added by being adopted by a large percentage of the decentralized Bitcoin nodes that verify the transactions. A second layer that included something known as the Lightning Network was adopted and allows transactions to occur very, very fast. The Layer 1 technology processes transactions slowly, but this allowed very fast transactions. If you recall our investment choices from a prior slide, stocks, have industry risk and counterparty risk. There are very few stocks today that were in existence 100 years ago. Real estate is expensive to own and expensive and slow to move. Gold, expensive to store, expensive to move, expensive to mine. Gold sales are also taxed as a collectible, as we discussed, subject to a higher capital gains rate of 28%. The US dollar has inflation risk and counterparty risk. The government can inflate it, meaning it will buy fewer and fewer goods and services over time. Adoption. A large number of holders are using Bitcoin as a primary reserve. Today, it has a network effect. It is what many people use to transfer funds instantly and cheaply around the world. Utility. Currently, it is very slow and expensive to send money to other countries. You can do it with Bitcoin instantly with virtually zero volatility using apps such as Strike, which we will discuss in a minute. Other digital assets are usually controlled by someone or something, even Ethereum, so they aren't truly decentralized and they are not likely to replace Bitcoin. Stock to flow is the quantity in existence divided by the new amount created each year. Bitcoin has the highest stock to flow ratio of any currency and therefore the lowest inflation rate. The stock is the amount in existence, about 19 million now, and the flow is the new amount created each year by mining. Interestingly, the original stock to flow models, I was doing research for this talk, show that Bitcoin's price would be about $55,000 in 2021. We passed that threshold twice this year. There are issues with this model, as obviously Bitcoin will not grow exponentially forever, or probably won't. Volatility. As I hope you have realized from our earlier slides, stocks are very volatile. Bitcoin trades in a true free market based on supply and demand with no controls and is more volatile than stocks. Transparency. All transactions are anonymously reported on the blockchain. Energy usage. Comparing Bitcoin's energy usage to other major industries. China was the biggest source of emissions from Bitcoin mining. And now that China has evicted its miners and outlawed Bitcoin transactions, a large portion of the grid has moved from coal to natural gas. That's a good thing. Check out the Bitcoin Mining Council's website for information on energy use. One interesting fact is that Bitcoin is moving towards sustainable energy use, including using the electricity that is generated but wasted. It is estimated that about 30 to 65% of the world's electricity is actually wasted because it is generated and can't be stored. And Bitcoin is trying to take advantage of this, so it's not taking out new energy, it's using existing energy. Also, a lot of the mining apps that the miners that left China, some of that mining capacity was recreated in Texas, which also seems to be a hotbed of sustainable energy use. Whoever controls the money can inflate it or confiscate it, which is why digital currencies are not the same thing as Bitcoin and are unlikely to replace it. Bitcoin scams. As long as there has been money, there have been people trying to scam you out of it. Don't fall for any scam, including offers that seem too good to be true. This applies to all forms of money, not just Bitcoin. In 2013, the largest exchange in the world was Mt. Gox, based in Japan. They handled over 70% of the Bitcoin transactions. Starting in 2011, someone hacked into the exchange. And by 2014, no one had apparently noticed, and they had stolen over 740,000 Bitcoins from the exchange, from customers and Mt. Gox itself. Mt. Gox went bankrupt, and everyone lost their Bitcoin. That would be like Coinbase being hacked today. This is why you will continue to hear not your keys, not your coins, and best practices are to store your Bitcoin yourself. How do you do that? We'll talk about that. Bitcoin can be stored in a wallet, in an exchange known as a hot wallet, or transferred to a separate flash drive type of device, not connected to the internet, but with a very long password key. That's known as cold storage. A lot of the exchanges today will pull the Bitcoin down off of the internet into their own versions of cold storage with their own protections, and everybody is trying not to recreate the Mt. Gox debacle. However, there really is no guarantee if you have your money with an exchange or any online business that you will be able to have, that it won't get hacked. There is always a risk of hacking. Mt. Gox also had cold storage, and that also got hacked. There was a number of security problems there. They're probably not repeated now, but you never know. Like I said, there's a lot of unusual risk with Bitcoin. This way of storing it in the drives, the little disk drives, they're special to Bitcoin or digital assets, known as cold storage, is generally the safest because it is not connected to the internet, so it can't be hacked. However, if you lose the passphrase, you're toast, it's gone. So if you die or disabled and you're the only one that knew it, too bad. In 2019, just a couple of years ago, the 30-year-old CEO of a Canadian exchange died suddenly with the only key to his exchange's cold storage, and all his customers were out of luck. Bitcoin is already being used as a currency. Foreign countries can transfer instantly at almost zero fees in any currency. It seems Bitcoin is replacing Western Union. El Salvador uses Bitcoin as a currency today. Have you ever tried to send money to or from a foreign country? It takes a long time and it's expensive. There is an app. A gentleman named Jack Mallers, young man, created an app called Strike, and he is building a huge customer base by letting people buy Bitcoin for basically free. You can transfer a certain amount of money from your bank account into the Strike app. It's limited to like $250, $500, $750, something like that, relatively small amounts. But he's getting users to sign up because they can buy Bitcoin, and there's no cost. You try to buy Bitcoin on Coinbase or Gemini or any of these others, and you're paying maybe 1.5% to 2% for your purchase. So that's a big deal that Strike lets you buy it for free. You can then send the Bitcoin to an electronic wallet of your choosing for safekeeping, for security. You don't leave it on the Strike app. You buy it and immediately transfer it off. By leaving cash in your Strike app, you can purchase from vendors who take Strike. Now that he's going to have this huge customer base, he's going to go to companies like Starbucks and say, hey, you take the Strike app, and the fees that he gets from that are very small compared to the vendor paying MasterCard and Visa 2.5% to 3.5% of every transaction. It reduces the business's fees, credit card fees, to near zero, saving the business 90% on credit card fees and costing the customer nothing. This works by, it takes your cash, converts it to Bitcoin, and then instantly converts it back to cash. So converting to Bitcoin, moving to Starbucks, converting back to cash, so it eliminates the volatility risk. You can also send money instantly to anywhere. This uses, just as I mentioned, this uses the Lightning Network portion of Bitcoin. That's why you can do so many transactions, because of the second layer, layer 2 Lightning Network. And it eliminates the volatility risk of holding Bitcoin directly. Strike has recently partnered with Twitter to allow tipping in sats. If you remember, sats are less than a penny. Bitcoin gives, most importantly, Bitcoin gives banking access to millions of unbanked and underbanked customers around the world. All they need is a smartphone. There is no gatekeeper. It doesn't matter if you have bad credit. It's a lifeline for poor people. A lot of people work in the United States, and they might send money back home to Mexico or El Salvador or whatever. If they can send it in Bitcoin, it's instant. Instead of sending it to Western Union and having their relatives have to take a 3-hour trip to get to the local Western Union, it's much quicker and safer, and they don't have to take time off from work. And it's a very big deal for poorer people in other countries. Security. It is very similar to cash, physical bills. You don't tell anyone you have cash in your house because you might get robbed. If someone takes your cash, you can't tell it was yours, and they can spend it. Ditto for Bitcoin. Same. If you can't use a password manager such as LastPass, 1Password, there's a bunch of different ones, you should not own Bitcoin or any digital assets outright, as the chance you lose your coins are high. Not your keys equals not your coins. If anyone gets your password or your passphrase, then they can get your Bitcoin, just like they walked into your house and picked up your cash. If you're not, stable coins. Let's talk about stable coins. Stable coins are another form of digital assets. They look like bank accounts. They look like savings accounts. But they are very, very, very risky. You know how you know they're risky? Because they're paying 7 to 8% interest. There is a correlation between risk and return. If something has a high return, there's a really good chance it's pretty risky. Basically, with a stable coin, you are loaning your cash to another entity for it to use. Basically, all these entities want to take stable coins. They get money to do all these fancy trading gyrations with digital assets, such as shorting it. Anything you can do with a stock, you can do with Bitcoin or any of the other digital currencies. So you can short it, you can bet on it, you can make fancy derivatives, you can take out leverage. I don't recommend anyone do that, but that's what the people who are borrowing your stable coins are doing. So when you stake, it's called staking your stable coin, you are lending it out to other unknown parties that are then lending it out to others to do all this fancy trading. Interest rates paid on your stable coin are higher during bull markets when the price is going up, and they are lower during bear markets when the price is going down, because fewer people want to be doing that fancy trading because they were all wiped out. As risky as they are, it's just a matter of time before investors find out you can get paid 7 to 8% on your cash by buying and staking a stablecoin. All stablecoins are risky, as we mentioned, but some are more stable than others. Think of stablecoins as digital money. Even though the prices don't fluctuate, they are still very risky. Types of stablecoins, a very small list of stablecoins. There's a zillion of them. DAI is one of them. Gemini dollar is another one. USDC is a large one, and Tether, I think, is the biggest, which goes by USDT. There are many, many, many others. Before investing in a stablecoin, find out what is backing the cash in the coin. Is it dollar for dollar? Gemini has dollars in the bank for every dollar in stablecoins that they issue. Or is it commercial paper to $1, which is what Tether has, which is very, very scary. Tether being the largest stablecoin out there. Huge amounts of money are in Tether, and it's not backed by dollars. So it's almost like the issue of Tether is printing money, because it's US dollars, can be used like US dollars, but it's not US dollars because it's not backed by a dollar. Is the stablecoin audited? How can you trust what it's backed by if you don't know it's audited? I don't suggest borrowing to buy stablecoins or Bitcoin, as I mentioned before. That can be very, very dangerous because these are a very volatile asset class. By investing in a stablecoin, you can theoretically lose your entire investment if the borrower defaults. All of the fine print when you sign up to get that 8% interest rate says that you are taking the risk that you could lose your entire investment. As I said, it's very, very risky. I have not yet seen that happen, but it's only been a few years. They are still such a new investment that I wouldn't bet on that. Stable coins are big business, though, as you might imagine, because they're paying a lot of interest in an economy where we can't really get any interest on anything. And the issuers have an incentive to keep people whole, so they continue to invest. I have no opinion on which one is best, but I do like that Gemini is regulated by the state of New York, audited, and backed by dollars. Digital assets are, oh, we skipped a slide. Digital assets are very volatile, both up and down. Avoid salespeople trying to get you to buy any kind of digital assets. I can't really give an opinion on non-Bitcoin digital assets. There are more than 12,000 of them. All the same risks apply. Understand what you are getting into. Not your keys is not your coins. And again, this is referring to the private key for your digital wallet that we mentioned earlier. Leaving your coins on an exchange, like Coinbase, for example, means they aren't technically yours. Coinbase has given you an IOU, and they are holding your coins. Make sure you have the ability to transfer them to cold storage, again, which is the physical device. Not all wallets allow this. As an example, notably, Robinhood does not allow you to transfer your digital assets out of their custody. I would stay far away from any exchange or custodian that doesn't allow you to transfer to other custodians or to cold storage. That seems kind of risky. I believe they are trying to develop some way of doing this, but currently they don't. PayPal, which also lets you buy Bitcoin, and when they came out with their let you buy Bitcoin, they also didn't let you transfer out, but I do believe they do let you transfer now. Before you buy Bitcoin or any digital asset, you should know how to lock down all security features of your computer and your wallet app. You should use a password manager and know how to lock down its security with two-factor authentication on everything. You should protect your email account with two-factor authentication. One of the ways to hack your digital asset account is to change your password, somehow hack your email and be able to get your emails from the place while you're sleeping. Again, they can't do that if you have two-factor authentication going. And you should also have worked out a contingency plan for estate planning. If you die or disabled and are the only one with the key or password, your coins are lost. You should understand that owning Bitcoin is like having cash strewn around your house. You wouldn't tell anyone you had $50,000 in cash at home, so please don't tell them you own Bitcoin. Choose an exchange that participates in Know Your Customer, which is known as KYC, Know Your Customer, and make sure the exchange is audited or regulated by the United States. Lock down your wallet. A lot of wallets allow you to set up no transferring to addresses unless you add them, so if you've locked it down so it's not possible to transfer it out, or it's very difficult, and then like I know Gemini has a 7-day hold if you add another wallet to transfer out in the future. It's just another security feature. Another option, just like you would invest in stocks slowly over time, dollar cost averaging in. If you are going to be investing in digital assets or stable coins, I would suggest you invest slowly over time in small chunks over many months, eventually getting to some kind of split between maybe Bitcoin and stable coins if you want to do that, all of which is very, very risky. Stable coins are not principal protected like savings accounts are, even though they appear not to fluctuate in value. I would limit your Bitcoin digital assets to 1 to 10% of your entire portfolio. Your total investable assets, I would not sell them before you've held them for 1 year to manage your taxes. And I would rebalance your entire portfolio. Bitcoin and any digital assets are going to move all over the place. You have to have a strong stomach and follow the same rules you do for your stock portfolio, which is you don't sell based on daily news, daily market movements. Doesn't matter. You steady Eddie, buy more when it's low, et cetera, et cetera. Watch your fees. Fees can be very high in this space. And again, going back to Strike trying to take the market share, allowing you to buy for basically free, but you can't buy very much because of their limits. And again, don't store your Bitcoin on Strike, Robinhood, or other apps. Use an exchange that either uses cold storage or use a self-custodial wallet. They have these electronic wallets that will take custody, but you have the password. They create a little file for you that is the password file. Moon is an example, M-U-U-N, such a wallet, or transfer to cold storage. Bitcoin is like physical cash more than it is like cash in the bank digital. And it is very, very, very risky. Stable coins are very, very, very risky. Tread very carefully in this area. Understand the tax consequences. When you sell it or spend it, it is subject to capital gains in the United States, and you must report it on your taxes. Institutional adoption. For the most part, large institutions still don't own much in digital assets, and investment advisors don't give advice on digital assets. This is because there is no institutional pricing yet. The more money you manage, the less in fees you pay based on your assets under management. Current custodial fees for Bitcoin are from 0.6% to 1.5% per year, which is really, really high for institutions, and institutions don't want to pay that. Any asset management fees would be on top of these fees. That's just for custodying the asset. There are compliance issues with 24/7 pricing. Who's going to be trading if the market goes down and everyone's sleeping? Accounting and tax software is still being developed with all of the movements. If you spend your Bitcoin or transfer it around, you have a tax impact, and you need accounting software to calculate all of that. And the accounting rules for United States companies that are public require that investments be adjusted to the lowest fair market value it traded at ever. So that can be very problematic when Bitcoin has a dip way, way down, and then it goes way, way up. You have to record it at the way, way down lower value and book a loss on your financial statements. And lastly, but not least, it is difficult, if not impossible, to obtain errors and omissions insurance in this area. So right now, there are very, very few institutions invested in Bitcoin, but this is expected to grow as these issues are resolved. But Bitcoin is so complicated. For comparison, let's look at the US dollar system. Pretty much nobody understands all the complexity of the US dollar system. Those who want to get rich fall into a temptation and trap, and into many foolish and harmful desires that plunge people into ruin and destruction. 1 Timothy 6:9. Keep your investment urges in check and follow the best practices I laid out above. Stop looking for the one best investment and diversify. Let's talk about economics, money, and inflation. During the 1980s inflation, the government didn't own as much debt. Now it does. Interest rates can't increase today without straining the government budget with the interest payments. As assets continue to rise, are they appreciating or inflating? It is difficult to tell. As money enters the banking system, interest rates fall. The Fed is currently preventing future rate falling by issuing, meaning selling, overnight bonds from counterparties in exchange for cash, adding the cash and a resulting liability to the Fed's balance sheet. This is known as a reverse repo. The counterparties, which are often hedge funds and large money market funds, therefore lend out the treasuries to others. The amount of reverse repo skyrocketed in June 2021 when the Fed started paying 0.05% on the treasuries risk-free, encouraging counterparties to buy them from the Fed. This is overnight. They buy these things overnight. This is a sign that enormous amounts of cash injected into the economy is having trouble finding a place to go. Watch the reverse repo market, the Fed buying larger amounts each night from counterparties. I think it's down a little today, but last week it was up to $1.6 trillion a day for overnight balances. This is necessary because a glut of cash is in the system. It also indicates that the big banks aren't lending, likely due to lack of demand. What does this all mean? I don't know. The impact of this is unknown at this time. It might mean high inflation is on its way. I do know is that if the Fed wasn't doing this, buying all of this cash and sucking it up, interest rates would fall because, again, supply and demand, there's too much cash. So that's why they're buying it, to keep interest rates stable. A good reminder to help us wrap up. Jesus didn't say don't plan for the future. He said be present in the moment and don't worry about the future. We covered a lot of material. Are there any questions? Right, so if you have any questions, again, you can put them in online, and someone will read them off, and we will answer them here. Excellent.
Do you see Bitcoin being used as universal currency anytime soon?
No.
Okay, and another one. What apps would you recommend to an individual investor investing in non-digital assets?
What acts?
Apps.
Oh, okay. That might be a question as where you want to put your money. For example, I'm a big fan personally of mutual funds, which can be at a mutual fund company. I would choose a low fee company. But this gets complicated, and I really strongly suggest somebody get professional advice in this area. But Vanguard, for example, is a mutual fund company that has low fee index funds. Fidelity is another.
Okay. Another question. How do you feel about income investing, including CEF, ETF, and stocks?
CEF, ETF, and stocks. Income investing, is that what it says? Mm-hmm. Income investing. So how I feel about investing is you should be investing for total return, not just income and not just growth, because it's not about, when it rains and snows, it's all just water. And so whether it's growth of the portfolio or you're earning dividends, it all goes together. It matters what is the total return of the portfolio and what is your total expected return over the lifetime. If you're getting 4% interest, that's great, but if your total return is only the 4% interest, that's not great. That's not a great long-term rate of return compared to the alternatives. So once again, if you're taking money off of your portfolio, you are taking distributions out of the account, you don't have to be limited to just income. This is a big concept that a lot of people don't realize.
Okay. When looking to invest in stocks, mutual funds, or ETFs, what are some of the costs associated with each? Can you give a brief overview of the expense ratio?
Sure, that's completely different. So whether it's an ETF or a mutual fund, the expense ratio can vary from just a few basis points. A basis point is a 1/100th of 1%. So it can be virtually free. Fidelity has some basically free, no fee mutual funds. There's a lot of very inexpensive ETFs. And then for some actively traded mutual funds or actively traded ETFs, the expense ratios can go up to 1.5%, 2% a year. So we don't obviously recommend those. I prefer the lower fee types, but you have to look not only at the annual expense ratio, but whether or not there's a commission load, which you don't see too much anymore, or other options. ETFs are generally cheaper than mutual funds, and stocks, of course, don't involve any expense ratios whatsoever, but they do involve commissions, and then you have single stock risk. I really don't recommend investing in single stocks. It's too risky.
Where do money market accounts fit into your portfolio?
So your money market accounts are for your cash balance, your emergency fund. The traditional advice is to have an emergency fund of 3 to 6 months worth of expenses to cover anything in case, let's say, I don't know, your roof leaks and you need a new roof. And so you can use, I like using that into a money market fund, because a money market savings account, the interest rate is going to depend on overall interest rates. I'm a big fan of the internet banks using, various banks have various higher interest rates, but Ally Bank, Capital One Bank, E-Trade Bank, there's a lot of these internet ones that tend to have higher interest rates than your local bank, which will be paying less. So I like to use those for the emergency fund. I'm not a fan of CDs as much. I do like money markets better because, again, as interest rates rise, the money market rate will increase versus being locked in a CD. But in the end, it really doesn't matter whether you use CDs, money markets, or other avenues for cash, because interest rates today are so low. The whole point of that, remember, you're not chasing yield. You're just trying to have stability. You want cash to be cash to be cash. Even though next week, next month, and 3 months, it's going to be worth less. It's going to buy less stuff. The reason you have it is in case you lose your job, or again, you need money to buy a new car or a new roof or whatever. Everyone needs some kind of cash.
What's the difference between Roth and regular IRA? Should I have both?
Excellent question. I would defer you back to our taxes discussion 2 weeks ago, or our retirement discussion last week, where we covered this. But a Roth IRA grows tax-free forever, as long as you're alive. And a regular IRA, should you have that? Generally, if you have access to a 401k, then you may not need an IRA, and it really depends on your tax bracket. If you're in the highest of tax brackets, then we do like 401ks or IRA deductions that are pre-tax. But if you are in lower tax brackets, really a Roth IRA is probably best, because you don't want to put into a tax-deferred account when you're in the 12% tax bracket and then have it come out 30 years later when you're in the 35% tax bracket. That makes no sense, because you didn't get as big a tax deduction as you're paying on the other end. So it's a loaded question, and it really depends completely upon your situation. So again, I can't emphasize strongly enough that having somebody else look at your situation to answer that one for you particularly.
I have a question about Bitcoin. So
Yes.
explain to me, if the price of one Bitcoin right now is $50-something thousand,
Yes.
how does one buy Bitcoin?
Oh, excellent question. So if you go to one of the exchanges and you've done all the security and you've set up your account and you're confident in the security, you can buy any amount of Bitcoin. You just say, hey, I want to invest $25 in Bitcoin, and it buys $25 divided by 50,000 worth of Bitcoin out to 6 decimal points. And you'll have 0.00003 of a Bitcoin in your account. And I mean, you can dollar cost average it in like anything else. There is no real purpose for one whole Bitcoin being priced other than as a unit of account to show how much you have. But good question.
studio audience? Sean, come on.
He's always good for a question.
So you mentioned real estate investment trusts.
Yes.
Is that something that you should do as opposed to just holding real estate, or are they different? And how does that fit in? Because that was one of the listed
It was, yes.
things that weren't struck through,
Correct.
but it also wasn't extensively discussed.
Yeah, no,
So-
that's very true. A real estate investment trust is like owning a diversified real estate portfolio and collecting the rents. You get paid dividends, usually monthly or quarterly. So real estate investment trusts are not tax efficient, and they are best held in IRAs or other, or Roth IRAs and other non-taxable accounts. Better than actual physical real estate. Well, physical real estate, if you own a rental property, you have to repair it, stuff breaks, you have to be a landlord, you have to chase your rents. So if you don't want all of that hassle, real estate investment trusts are a great alternative. They, again, are diversified, and there's a lot less hassle, and they also get the business tax break deduction that other businesses get, whether it's a rental property or the real estate investment trust dividends. It's taxed at a slightly lower rate. So they are completely different, and one versus the other really depends on a lot of things, because you're not, with real estate, you can take a more low interest mortgage and leverage yourself into real estate, but again, you still have all that hassle, versus a REIT where you just sit back and collect the income, and it's a great diversifier. It is a separate asset class from other kinds of stocks and bonds because it moves, its correlation is different, so it moves at a different rate. Thank you for the question, though. That was a good one. Okay, thank you very much.